Ben, walk us through your take on the earnings here, because it looks like the market was disappointed.
Good morning, Matt, and thanks for having me. Well, I think $4.7 billion of clean earnings, I consider it a very solid result. If you decompose it a little bit, look at integrated gas, up with a factor 2 compared to the same quarter last year. Our upstream business up with a factor 4 compared to the same quarter last year. Our downstream business more than 30% down. That is very much linked to a very difficult refining environment, a very difficult trading environment as well. Now, you talk about rising oil prices, and therefore you would have expected more from our upstream business. You're absolutely right. Brent is up 50%, but WTI, which we are also significantly exposed to, only up 40%. The Canadian gas market down 50%. Henry Hub down 7%. So it's a mix of things that plays through there as well. There's a few exchange rate effects that also work through. They have a non-cash impact. And therefore, our earnings as a result of that are sometimes not as straightforward to predict as we would ourselves like as well. If you look at the cash picture, though, Matt, it's a very strong quarter.
We'll get to that for sure. What were the exchange rate issues here, Ben? And do you see that continuing going forward?
There's a number of exchange rate effects, and again, it's a bit nitty-gritty, but let me explain them in sort of high-level terms. First of all, the exchange rate effects basically caused us to have some higher operating costs. There's other reasons why our operating costs are a bit higher, which we have to pay a little bit more attention to as well, like more maintenance. But there's also exchange rate effects that work through on some of our tax positions, causing taxable events, which are non-cash. And then, of course, the way we have structured the company in terms of intercompany loans also move as a result of exchange rate effects, where we have to revalue some loans in local currencies. So these things are harder to see. Again, as I said, they have a non-cash contribution to earnings. But if I can come back to the cash piece now, Matt, at $11.6 billion for the quarter after working capital, it's a very strong quarter. It's the best quarter since Q1 2014, when the oil price was above $100. And strictly speaking, you can add back to that also the variation cash margining that we have to do for our LNG hedging program. So that's another $800 million. So on an underlying basis, this was a $12.4 billion cash from operations quarter. And that is a very important component in our confidence to start the buyback program that we committed to.
Ben, I'll give you a comment from an analyst, Alex Brooks at Canaccord, and you tell me what you think. He says the only way Shell has been able to generate cash is by selling assets. And then he says it's not a good place to be. Hopefully, at least for Shell and its shareholders, things will change as the cycle matures. What do you say to that?
Well, we indeed have been divesting quite significantly. We made a commitment to divest a $30 billion worth of assets. Partly that was to pay down debt, but more importantly also to upgrade our asset portfolio. We're essentially done with the $30 billion. We're putting the finishing touches on it, but we will deliver the $30 billion by the end of this year. But if you look at the free cash flow excluding that divestment program, and you have to correct for working capital. We have a major move in working capital, $6 billion worth of working capital move over the last 12 months running. We essentially, with our organic free cash flow, we cover our total cash dividend as well as interest payments. There is more to come. We are still ramping up new projects. There's, between now and the end of the decade, another $15 billion of operating cash coming from new projects, or projects ramping up. So we are very confident at the end of this decade, we will be looking at $25 to $30 billion of organic free cash flow, from which we not only will be able to service our debt, service our dividend bill of around $15 to $16 billion, but also indeed execute that $25 billion buyback program and then some more.
We have Javier Blas, our chief energy correspondent, points out that you're spending very cautiously. In the first half, Capex was $10 billion. I think it was $5.3 billion in the quarter, $4.8 billion in the previous quarter, and that's below your $25 to $30 billion target, well below. Are you going to start to pick that up as you're generating so much cash?
Yeah, our spending programs, of course, phase through the year. There's a bit of picking up and spending as some projects will continue to ramp up during the construction phase. We still look at a sort of low end of our $25 to $30 billion range as the estimate for the end of the year. We said we will be very disciplined. Last year, we also delivered against the discipline to stay at the low end or even below the range last year. I'm very confident that we will come out around $25 billion, give or take $1 billion at the end of this year.
What about production? Are you going to be able to pick that up? Because you weren't able to boost production, weighed down in part by divestments, right? I think it was down 7% to 2.48 million barrels a day equivalent total production. Is that something that's going to change in the second half?
I think what you will, if you look at the production numbers, you're absolutely right. They, on a headline basis, they're down. You're also absolutely right that that's, of course, very much determined by the divestment program that also had significant amounts of upstream divestments in there. If you strip that away for a moment, you will first of all see that our integrated gas production growth was very significant, double-digit growth. But if you look at the overall integrated gas upstream on an underlying basis, so take away the divestments, then we were up more than 5% in production growth. Now, as our divestment program is sort of getting behind us, the portfolio becoming a little bit more stable. We will, of course, continue to be in sort of portfolio maintenance mode. You can expect production to grow, and some of it you will start seeing in the second half of this year already.
Ben, I wonder what you think of the fact that world leaders are now starting to join in to talk about energy prices, to demand changes in energy policy, to sell liquefied natural gas. I mean, what do these developments, especially out of the White House, mean to you as the CEO of Shell?
Well, I think it is consistent with our outlook as well. Look, you know, oil demand will still continue to grow for quite a few years to come. But gas demand will continue to grow much faster. And if you look inside gas demand, you will find that LNG demand will continue to grow even faster than that. So we see a very healthy future for the LNG market, growing roughly 4 times as fast as the oil market. And we will see that indeed in the beginning of the next decade, a significant gap will start to open up between the available supply and the incipient demand. And of course, we are positioning for that gap to open up if we are considering, you know, expansions and new greenfield projects. And Europe, indeed, will be an important target market in that respect as well. Indigenous production in Europe is in decline and will continue to be in decline, I think, from now on. And therefore, Europe will have to look increasingly at imports, pipeline imports, but definitely also LNG imports, and definitely also LNG imports from the United States. So we are a big player in it. We are the #1 player in the LNG market, also the #1 player in lifting North American LNG and optimizing that in our portfolio, some of which indeed comes to Europe. So we are completely consistent with the views that we now hear also coming out of the White House and the recent President Trump-Juncker meeting. And that plays very well to the strategy that we've had for years now.